All right, welcome to our explainer. Today, we're going to dive into something that is absolutely crucial for any investor, spotting the red flags that hide just behind those shiny profit numbers. You know, the most important story a company tells is often the one it's desperately trying to hide. So, let's get into it.
So this sounds a bit like the start of a bad joke, right? What on earth do a theme park, a wind energy giant, and an electric vehicle startup have in common? We're talking about the companies behind Esselworld, Suzlon, and Gensol. I mean, they couldn't be in more different industries, but they all share a very, very dangerous secret.
And there it is. That's the punchline. Each one of them concealed these fatal flaws that were nowhere to be seen if you just took a quick glance at their stock price or their profits. And these are exactly the kind of hidden traps that can turn what looks like a great investment into a complete and total loss.
The best way to think about a company's health is to picture an iceberg, just like this one. What you see sticking out of the water, the revenue, the profits, the stock price, that's just the tip. The real danger, the stuff that can completely sink your portfolio, is lurking right there, hidden just beneath the surface. We're talking about things like debt, crazy complex corporate structures, and what the insiders are really doing.
And it's so easy to get fooled by those surface numbers. Take a company like Brightcom Group. If you ran it through a basic stock screener, it would look amazing. Fantastic growth in sales, fantastic profits. But underneath it all, it was a classic pump and dump scheme. The stock was just artificially inflated before it all came crashing down. The profit and loss statement was telling a beautiful story, but the reality was a complete disaster just waiting to happen.
Let's start with maybe the biggest hidden killer of them all, debt. Look, when the market is booming, using leverage to grow feels great. It makes you feel like a genius. But when that cycle inevitably turns, that same leverage becomes this crushing weight that can pull an entire company under. It is one of the single biggest reasons companies go bankrupt.
And this quote just captures the real-world pain of it all so perfectly. Suzlon, wow, it was once a darling of the market, a leader in the green energy space. But its story is just a chilling reminder of how quickly a high-flying company can be brought down to earth by debt.
So this timeline shows you exactly how the disaster unfolded. Between 2006 and 2008, Suzlon was on a shopping spree, using massive amounts of debt to buy other companies, and its stock just soared. But this whole strategy created an incredibly fragile balance sheet. So when the 2008 financial crisis hit, the music stopped. Demand just vanished, cash flow completely dried up, and suddenly that mountain of debt, nearly 18,000 crores, became impossible to manage. The company defaulted, and all that shareholder wealth, just gone.
This contrast is just so powerful. On one side, you've got Future Group. They expanded like crazy, using huge amounts of debt and leasing their stores. Then on the other side, you have their disciplined competitor, D-Mart, which kept debt super low and made a point of owning its own stores. When tough times hit, Future Group's fragile, debt-heavy model just shattered. But D-Mart, their resilient, debt-light model allowed them to not just survive, but thrive. Two retailers, two completely different destinies, and it all came down to their approach to debt. Okay, this brings us to what might be the single most important lesson in investing. It is shockingly easy to manipulate a profit and loss statement. Accounting rules have a lot of flexibility. But you know what isn't flexible? Cold, hard cash in the bank. That is why there's a saying, profit is an opinion, but cash flow is a fact.
Just look at this slide. This shows the ultimate red flag in action. The company, Gensol Engineering, reported these soaring profits of 53 crores. On paper, they looked like a rocket ship, but their cash flow, that told the real story. It was a staggering negative 98 crores. They were burning through cash like crazy while claiming to be profitable. And this huge disconnect was hiding a really dark secret. Funds were allegedly being siphoned right out of the company for personal use.
And that's exactly why this statement is so incredibly powerful. If you want to know the truth about a company's health, don't start with the P&L statement. Start with the cash flow. It truly is the truth serum of finance. It just cuts through all the jargon and tells you what's really, really going on.
So here's a really practical rule of thumb you can use. A healthy, honest company should be able to convert at least 70 to 80% of its reported profits into actual cash. If you see a company that consistently fails to hit that benchmark, that is a major, major warning sign that the profits you're seeing on paper might be pure fiction.
All right, let's switch gears a bit, from the financials to the people who are actually in charge. Think about it like this. If the captain and the senior crew are all jumping off a ship, you probably don't want to be getting on, right? Well, it's the same with companies.
Frequent resignations from directors, key managers, or even the auditors are one of the most reliable signs that there's big trouble ahead. And the Z Entertainment saga is just a textbook case study of this, and it all started with directors resigning. Here's basically how this time bomb was built. Step 1. The promoters took their shares in Z and pledged them as collateral to get loans, but for their private businesses. Step 2. When Z's stock price started to fall, it triggered margin calls from the banks, meaning they demanded more money. Step 3. The promoters couldn't pay up, so the banks just force-sold all those shares on the open market. And Step 4. This massive flood of selling caused the stock to completely collapse, leaving public shareholders holding the bag for the promoters' private debt. And this chart, wow, this shows you the brutal result of that whole mess. As the lenders sold off all those pledged shares, the promoters' ownership just collapsed from over 40% all the way down to less than 4%. So who bought all those shares on the way down? The unsuspecting public, whose ownership shot up from 6% to 57%. The insiders got out, and the public was left with the wreckage.
So the big takeaway here is you have to watch for this pattern. A stream of directors leaving? That's a bad sign. A sudden auditor resignation? That is even worse. That means the people who are hired to check the books are refusing to sign off on them. And if a departing insider straight up alleges financial manipulation, well, that's your signal to run, not walk.
Okay, our final red flag is something that feels a bit more subtle, but it's just as deadly: intentional complexity. See, honest companies try to be clear and simple. Dishonest ones, well, they often build this confusing, tangled web of subsidiaries. And why would they do that? Because a complex structure is the perfect place to hide shady transactions and siphon money away from regular shareholders. I mean, just to give you a sense of scale, check this out. The Adani Group's key listed companies have a combined 578 subsidiaries. Now, for a regular retail investor, trying to trace money through that kind of labyrinth is literally impossible. That level of complexity can hide enormous risks. And here are 3 crystal clear examples of how this plays out in the real world. Vedanta's public company in India took on debt just to pay dividends, which then went to service its UK parent company's private debt. MapMyIndia spun off its most exciting, high-growth business to a private company owned by the promoter's son, cutting public shareholders out of all that future profit. And as we saw with Z, public money was used to back private loans. In every single case, value gets moved away from the public company and into private pockets.
I know we've gone through some pretty scary stuff, but look, the point isn't to make you afraid to invest. It's to make you a smarter investor. It's to empower you. So let's pull all of this together into a practical toolkit that you can use to help protect your capital.
So, here it is, your forensic checklist. Think of this as your shield. First, always check for high levels of debt. Second, make sure those profits are actually turning into real cash. Third, watch for that insider exodus. Fourth, be really wary if a high percentage of the promoter's shares are pledged. Fifth, question any corporate structure that seems needlessly complex. And finally, scrutinize every single transaction between the public company and any private entities. I want to leave you with one final question to think about. A great business in a fast-growing industry, that's the horse. But the management, the promoters, their integrity, that's the jockey. And you can have the fastest horse in the world, but if the jockey is flawed, you are never, ever going to win the race. So the next time you invest, just ask yourself, am I just betting on the horse, or have I actually done my homework on the jockey?